new strategy was flawed, complex, poorly reviewed, poorly executed, and poorly monitored. The portfolio has proven to be riskier, more volatile, and less effective as an economic hedge than we thought.
There's a lot of things going through my head on this, but when I heard it, it took me back to September of 2008 when I had to struggle to understand this thing about credit default swaps and AIG and how they were engaging in this business of insuring themselves against risk without regulation. And I thought, is this happening again?
Well, no, I don't think it's happening on a broad scale, and I would attribute Jamie Dimon for being very clear and owning up to the fact that his bank made mistakes. It was a nice contrast of some of the things we saw in 2008 when you saw a lot of CEOs getting up there and saying, oh, it wasn't my fault, it was the market, other banks were doing it, et cetera. So he deserves at least credit for owning up to the fact that this appears to be something particular to his institution. They made some serious mistakes. It does make you wonder, though, that this clearly is one of the best managed larger banks in the country. If this kind of thing can happen, what's going on at some of these other institutions? It really just raises broader questions about whether they are just too big to manage, even if they're good managers.
It brings us back to the question of regulation. That's now a big deal. Senator Carl Levin has already said it's the banks that are too big to fail that are now, again, we're learning, engaging in risky behavior. Tell me about the regulatory, not regulations themselves, but regulators. This is always a problem where the banks are going to hire the highest priced people who can work their way around the stuff, and regulators find it very difficult to keep up with this kind of financial engineering.
Right. They do, which is why I've been, the top of my reform list has always been getting a lot more capital into these banks. You are always going to have unexpected losses. You're always going to have bank managers, even at well-managed banks, things happening at those banks that are stupid and generating unexpected losses. If you have a thick capital cushion to absorb those losses, you're going to be able to stay ahead of it. But trying to, micromanage institutions, or even with, hordes of examiners going in there and hordes of regulations saying you can do this, you can't do that, things are always going to fall through the cracks. So first and foremost, we really need to get capital levels up. They have been increasing. They need to increase more. I think also regulators need to put a high priority on simplifying these banks, their legal structures, dividing the commercial bank from the securities firms, having intermediate boards and managers there to provide more direct, specialized oversight of these institutions. I think that would be a tremendous boon to better management, and also I think that would help shareholders also understand what's going on inside of these institutions. I was speaking to a fairly sophisticated investor group recently. This is before all of this came out, obviously, and I said to them, raise your hands. Who in this room understands what's going on inside JPMorgan Chase? And not a one of them raised their hands. So I think shareholders also have an onus to put some more discipline on the institutions and find out what the heck's going on inside of them.
We should tell our viewers, though, because I would imagine many of them will not really understand the highly complicated world of credit default swaps. This was done by what was called a proprietary trading desk. All of the investment banks have them, but in the old days, investment banks made their money by matching up investors and people who needed money. These trading desks are something, they're a relatively new creation, and they have traditionally made a lot of money for the banks.
Well, they have, and obviously this is the core of what the Volcker rule is trying to get at, is to ban trading, a bank taking directional bets on the market just to generate profits, not to accommodate a customer, but to generate profits for itself. It appears, again, I'm still learning about this, that it appears that this was a hedge, or what they call an economic hedge. So it was a hedge designed to protect JPMorgan Chase against broader economic risks that it confronted in the market. The Volcker rule, at least as currently proposed, may have actually allowed this, but a lot of advocates have been saying that the Fed and the other regulators need to narrow the hedging exception in the Volcker rule to make sure those hedges are tightly correlated to the underlying risks that they're trying to hedge. If you have a good hedge, you shouldn't have this happen. If you have a loss on one side, you should have a gain on the other to offset it. So a $2 billion loss on one side of a hedge is quite problematic, and is going to lead to a lot of questions and hopefully a tightening of the hedging exception in the Volcker rule.